Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Tuesday, August 17th, 2021, and in our preview of the week, we're discussing the major themes for the FX financial markets. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only. Good morning, Derek. And what are the key themes at the start of this week?
Good morning, Una. I think, as has been the case of late, there's still an awful lot of focus on the Fed in particular, in relation to the timing of tapering, and then mixed with that, then the Delta variant risks, which seem to come and go whenever there's an event or something to trigger concerns. It's there front and focus, and that's having an impact on risk sentiment as well. But I think this week we have Fed Chair Powell speaking at a town hall event, and that's ahead of the FOMC minutes on Wednesday. And then next week, of course, we've got Jackson Hole, and then the FOMC in September. So I think the market is focused on that because, of course, we've had a number of communications, some from senior Fed officials, that suggests there's been a shift towards a more hawkish stance. Certainly Vice Chair Clarida, in his comments on the 4th of August, talking about the conditions being in place for a rate hike at the end of 2022. And then there was a Wall Street Journal article yesterday which cited some FOMC members anticipating the QE taper program taking just 6 months. Now, the timing of tapering broadly has been communicated by Fed officials with what I think is consensus, which is starting around the end of the year. So September, we might get an indication of that, and then maybe the program starting November, December, something like that, I think is the consensus. But taking just 6 months is a bit faster than anticipated. And that would certainly be consistent with what Vice Chair Clarida said, that the conditions for rate hikes would be in place by the end of 2022. And when you look at the Fed funds futures, by the end of 2022, the implied Fed funds rate is sitting at around 0.25%. So if the markets really started to think that we could be getting rate hikes by the end of the year, there's still some scope for rates to move higher at the short end of the curve. And that, I think, would definitely reinforce the positive momentum that's there for the US dollar at the moment. Now, we did have a drop in the dollar at the end of last week on the very weak consumer confidence figures. Not convinced those are necessarily indicative of consumer spending data ahead. The report, the University of Michigan report itself, cited emotional responses based on the fact that consumers were somewhat surprised that the pandemic wasn't coming to an end. Of course, the Delta variant picking up in the US, the reason behind that. But of course, what consumers say in a survey is not necessarily what they do. And I'm not convinced the Fed will be too concerned about the consumer confidence report on Friday. So that dollar weakness is now reversing, and I think really what lies ahead for the dollar is going to be dictated by Fed communication. And certainly if the communications of late were confirmed by Powell, either at the town hall event this evening or at Jackson Hole next week, I think then short term the dollar could get a further lift. And that really is the focus over the short term. The Delta variant is there lingering in the background, and cases are picking up in the US. So that could come to a point where it starts to result in Fed communications being a little bit more conservative. So we have these kind of offsetting forces at play at the moment. And really, clarity will only be provided when we have Powell speaking either tonight or more likely at Jackson Hole next week. But our sense at this time is that the dollar will remain supported as the markets anticipate the timing of tapering.
And what else should we be looking out for this week, Derek?
Well, I just mentioned the Delta variant is there in focus from time to time, and certainly as we speak here now, it's definitely in focus and is very evident in the FX markets, with the Kiwi dollar down about 1.3% versus the US dollar. And that's on the news, the confirmation of a COVID case, a community case, the first such case since February. So quite a shock for the markets. It's only one case, of course, but it's unusual, as I said, and therefore there's been an immediate reappraisal of the outlook and therefore the monetary policy outlook. We have a trade view at the moment, long New Zealand dollar versus the Australian dollar. And the risk to that view has always been some shock factor hitting suddenly, because the New Zealand rates curve is very rich in terms of what's priced in terms of rate hikes. The OAS 1 year forward has a little over 100 basis points of tightening. The markets were fully anticipating a rate hike by the RBNZ tomorrow. So this news today has come 24 hours before that policy announcement, and immediately the markets are doubting the RBNZ moving forward with a rate hike tomorrow. The OAS 1 year forward, as I just mentioned, that has dropped by 11 basis points today. So that's nearly half a rate hike taken out on the back of this news. And that's resulting in a fairly notable liquidation of New Zealand dollar short long positions. Positioning data that we analysed based on a 2-year average, the Z score, the standard deviation is about 1.4 above that average. So long leveraged positions are certainly there in the market, and we could see further liquidation of those positions. I think clearly that's happening today, and there could be some further liquidation to go. The one caveat, the one potential support of reducing the squeeze on these long Kiwi positions is the fact that the RBA minutes came out today, and the RBA was dovish in those minutes by suggesting that they would act promptly on any further deterioration in the Delta variant situation in Australia. So a dovish RBA minutes means that the move on Aussie Kiwi is less extreme. And I think certainly from a positioning perspective, some of those long New Zealand dollar positions are versus the Australian dollar. And the fact that we've had a dovish RBA minutes today may limit the squeeze on long New Zealand dollar positions. Our own view is that I think the RBNZ will probably go ahead with the rate hike tomorrow. The macro backdrop is compelling, and the guidance they have given to the markets has been very clear. So they could act tomorrow anyway, but then the caveat will be a much more cautious guidance to the markets in terms of future rate hikes, which in itself would have been negative, I think, for the Kiwi dollar before this COVID event took place today. So I don't think, New Zealand dollar might bounce back a little if they do hike, but it's the guidance and, more importantly, the COVID data itself, and whether or not this short 7-day lockdown is extended will be the crucial determinant of direction for New Zealand dollar, and not necessarily the outcome of the RBNZ meeting tomorrow.
And finally, Derek, what trade ideas are your research desk highlighting this week?
Well, I've just mentioned one there that I've spoken about. So we still have that short Aussie Kiwi position still in the money despite the bounce that we've had today. So we'll hold on to that. We'll see what the RBNZ does tomorrow. As I said, it's really about the COVID data and whether or not this COVID case escalates. The other trade ideas, we've established a long dollar-yen trade idea. That was on our view that the move higher in US Treasury yields should be maintained. Now, we put this trade idea on before the consumer confidence report on Friday. So obviously yields have dropped since then, and dollar yen has come down. So we're a bit out of the money on that trade at the moment. I still think around the 109 levels should be quite well supported. Yields on 10-year in the US Treasury market, a range of 120 to 130, I think, seems plausible over the short term, until at least we get some clarity on Fed tapering. But by and large, we're expecting that communication to be supportive of yields, and therefore dollar yen should be pretty well supported at these levels around 109. Obviously, if there's a big risk-off event, or if Delta starts to really spread and become more problematic, then the yen could outperform. And then the other trade view we have at the moment is still long euro versus the pound. That's pretty much where we put it on a few weeks ago. There hasn't been much movement there. We did have pretty impressive jobs data this morning from the UK. The FX market didn't respond. Actually, if anything, the pound has weakened a touch since the data this morning. But we now have close to 1 million vacancies in the UK labour market. And we had a 180,000 increase in employment based on payroll data for the month of July. And we'd expect pretty solid job gains over the coming months, given the gradual reopening of the UK economy. And that should be supportive, we think, of the macro backdrop, and reinforce the message from the Bank of England earlier in August that some modest monetary tightening is going to be required going forward. So I think the macro backdrop is still reasonably supportive for the pound. And therefore, we're still holding the view that the euro sterling rate can grind lower.
Thanks very much for that insight, Derek. Have a great week, and we'll speak to you soon.
Thank you, Una, and you.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and reach out to your MUFG sales rep for further information. Come back next week for more insights from the Global Markets Research Team.